You ever notice how money disappears before you even get to enjoy it? Imagine this. You work a long week at McDonald's. You're tired, exhausted, just waiting for payday. Finally, your paycheck hits. $2,000. You check your bank account. 1,000 in वो फिर 600. Wait, what just happened? You scroll down and see it. Federal tax, state tax, Social Security, Medicare. It feels like invisible hands reached into your pocket before you even touched your money. Welcome to modern life. Now here's the truth most people never fully understand. Taxes are the price you pay for living in a functioning society. Roads, schools, emergency services, public infrastructure, even things you never think about. But at the same time, it also funds systems far bigger than you. Defense, healthcare, and everything in between. There isn't just one tax either. There are layers. Income tax hits what you earn. Sales tax hits what you spend. Capital gains tax hits what your money earns while you sleep. Then there's Social Security and Medicare. Money taken today to support retirement and healthcare later in life. And then comes the part nobody enjoys. Filing taxes. The funny thing? The government already knows what you owe. But instead of telling you directly, they make you calculate it yourself. And if you get it wrong, Sattan, well, that's when things get expensive. Some people pay quarterly, some pay yearly, some try not to pay at all, and usually end up in very public trouble. But despite how annoying it feels, there's a reason countries with higher taxes often have stronger infrastructure and higher quality of life. Now let's talk about something even more misunderstood: banks. You probably think a bank is just a giant safe. You deposit money, they guard it, and it sits there waiting for you. But that's not how it works at all. Banks are not safes. They're middlemen. When you deposit $1,000, the bank doesn't just store it. It lends most of it out, sometimes up to 90%. That system is called fractional reserve banking. It works because banks assume not everyone will withdraw their money at the same time. At least, normally. But in rare moments like financial crises, that trust breaks. People rush to withdraw everything. And suddenly, the system starts shaking. So how do banks actually make money? Simple. They borrow from you at a low interest rate and lend to others at a higher one. The difference is profit. And in return, they give you convenience, safety, and insurance protection. Up to $250,000 in the US. Now let's talk about something that quietly controls almost everything in your financial life: interest. If you borrow $1,000 and owe $1,280 back, that extra $280 is interest. Interest is basically the rent money pays to move through time. There are two types: simple interest, predictable, flat, easy. Compound interest, the powerful one. Because now your interest starts earning interest. And that's where things get dangerous or powerful. On debt, compound interest works against you. A small unpaid credit card balance can grow into something painful over time. But on investments, it flips. That's when your money starts multiplying while you do absolutely nothing. A $100 investment doesn't just become $200. It becomes $400, $800, and keeps going if you give it enough time. That's why people say time is more important than money. Because time is what allows compounding to actually work. Now let's move to something that hits everyone quietly: inflation. Ever notice how everything gets more expensive over time? That bag of chips that used to be $1.50 is now $3. That's inflation. It's not random. It's the gradual decrease in purchasing power. Your money stays the same number, but buys less every year. Why does it happen? Sometimes demand is too high. Sometimes supply is limited. Sometimes production becomes more expensive. And sometimes people just expect prices to rise. So they start buying faster, which pushes prices even higher. That's called a feedback loop. A small inflation rate, around 2%, is considered healthy. But when it spikes, savings lose value fast. To control it, governments raise interest rates. That makes borrowing more expensive, which slows down spending and cools the economy. But if things go too far the other way, we get a recession. A recession is when the economy shrinks for months at a time. Jobs disappear. Companies cut costs. People stop spending on anything unnecessary. Think of the economy like a party. During a boom, Mandota boom, everything is loud, exciting and fast. Then suddenly, the music slows down. People check their accounts. And reality hits. But recessions don't last forever. They reset the system. Eventually, spending returns, businesses recover, and growth starts again. Now let's talk about something that decides your financial future more than you think: credit score. A credit score is basically your financial reputation. A 3-digit number between 300 and 850. Low score. Higher risk, higher interest rates. High score. Lower costs, easier approvals. It's based on things like whether you pay on time, how much credit you use, how long you've had credit, and how responsibly you manage debt. Think of it like a trust rating. Not about how rich you are, but how reliable you look to lenders. Now here's something deeper. Money itself isn't actually physical value. It's shared belief. A dollar, a digital number, even cryptocurrency. All of it only works because people agree it has value. A one bill and a random piece of paper are physically different, but economically the difference is belief. Money is a system built on trust, not material. Which brings us to investing. Investing is how you protect yourself from inflation and build wealth over time. Instead of trading time for money, you let money work for you. Stocks, bonds, real estate, funds, different tools. Same idea. Put money to work and let time multiply it. But investing is not about luck. It's about patience. Most wealth isn't created quickly. It's created slowly over years of consistency. And finally, value. Money follows value. If you solve a problem people care about, money follows you. That's why doctors earn more than most jobs. That's why tech companies scale into billions. That's why brands can charge 10 times more for the same product. Because value is perception plus usefulness. And if you understand how to create value, you understand how money actually works. And underneath all of this, taxes, banks, inflation, credit, investing, there's one final truth. Time is the real currency. Because everything in finance depends on how long you can wait. Those who understand that don't just work for money, they let time build it for them.